1 quarter. That's all it took to silence a room full of skeptics. You'd heard the warnings for months. Fund managers calling AI the biggest risk to the market. Headlines asking when the bubble would pop. Everyone assumed the next earnings report would confirm it. That assumption turned out to be wrong. One company's numbers just walked into that argument and knocked it flat. And the way it happened tells you something most investors are still missing. For most of this year, you've watched a familiar pattern repeat. A tech giant announces massive AI spending. The stock drops on fear. Analysts warn that none of this capital expenditure is paying off yet. By mid-2026, that fear had a name. Nearly half of fund managers surveyed called an AI bubble the single biggest risk to markets. A year earlier, almost none of them said that. So ask yourself something. What would it actually take to prove them wrong? Not a promise. Not a roadmap. Revenue. That's exactly what Microsoft delivered. Its cloud division grew at its fastest pace in 4 years. Revenue climbed 17% year over year, beating what Wall Street expected. The stock jumped 15% in a single day. Here's why that number matters more than it sounds like it should. For years, AI spending has been treated as a bet on the future. Billions poured into chips and data centers, with investors told to trust that profits would eventually follow. Microsoft's report was one of the first times that promise showed up as an actual number, not a forecast. The timing made it even more dramatic. Just 1 day earlier, the Nasdaq had entered a technical correction. Semiconductor stocks were sliding. Investors were dumping AI-adjacent names and rotating into safer, defensive sectors. Then Microsoft reported. The Nasdaq jumped 3% in a single session. Chip makers that had been sinking for days suddenly rebounded. One earnings call reversed a market-wide mood in about 24 hours. That kind of swing raises an uncomfortable question. If sentiment can flip that fast in one direction, how much do you trust it when it flips the other way? There's a pattern that shows up again and again in market history. Fear spreads faster than facts. A single data point, repeated enough times across headlines, starts to feel like certainty. Back in 2000, the same thing happened with internet stocks. Some companies really were built on nothing. But others, the ones quietly building real infrastructure and real revenue, got dragged down by the same panic anyway. History didn't spare the companies with real numbers behind them, at least not immediately. That's the uncomfortable part of every bubble debate. Being right about the risk and being right about the timing are two completely different things. Microsoft's results don't erase every concern floating around AI spending. Analysts are still watching hundreds of billions in data center lease commitments most companies keep off their balance sheets. The debt behind this build-out hasn't disappeared just because one earnings report beat expectations. But something shifted that day. For the first time in a while, the story wasn't just about how much money was going out. It was about how much was actually coming back in. That distinction is easy to lose in the noise of headlines and hot takes. Spending numbers get repeated constantly because they're simple and dramatic. Revenue numbers get buried in earnings calls most people never listen to. Ask yourself which one you've actually been paying attention to. The investors who look past the loudest headline and toward the actual numbers underneath tend to see the picture months before everyone else catches up. That habit matters more than any single earnings report, this one included. 1 quarter didn't end the AI bubble debate. It probably won't be the last time this argument flares up either. But for 1 day, in one earnings call, the room full of skeptics went quiet. Not because someone won the argument, because the numbers finally showed up to answer it.